So, underweight DM, does the outcome of the debt ceiling negotiations change anything at all? And if not developed markets, where are you seeing more compelling avenues for returns?
Great. Thanks for having me this morning. So yes, we are starting point underweight developed market equities, and as a result of what we think is a pretty challenging environment in the near term, we don't think that some of the damage that will come with the fastest rate hike since the 1980s is yet reflected completely in equities. That's the bigger picture story. In the near term, the debt ceiling is fairly focus of attention right now. Everybody's focused on that, and there's going to be ups and downs, so we expect more volatility. But we expect that to get out of the way at some point over the next few weeks. And once this is out, the bigger picture question is what happens in terms of the economic activity in DM economies. We don't think the damage is fully reflected yet. So that's the near-term concern or cautiousness. But longer term, on a 5-year basis, we already see equities, DM equities, being attractive. So it's really a question of horizon.
How much attention are you paying to the China narrative? Because the patchiness of the recovery, not to mention the geopolitical overlay that we are seeing sort of coming to a head in terms of how the G7 will be addressing it in their meetings, have caused quite a bit of concern for foreign investors.
So one place where we are positive in the near term, more tactically, is on EM, emerging market equities. We think the restart that is happening in Asia is real, continues to be a tailwind. We think that the policy support that can come on the back of some maybe weakness that could happen is there. So there's more room to maneuver in emerging market economies. They're more ahead of the hiking cycle. Inflation response is more advanced. So that creates a more favorable kind of backdrop. And China is one of the kind of restart engine here. We've seen a bit of weakness this week that is raising a bit of concern about how much animal spirit there is in the consumer side of things in China. But I think this is offset by the fact that they have more ability to respond if needed through triple R cuts if needed. So that is a better position to respond to weakness than you would see in DM economy. So we see some better outlook there, and we're overweight EM equities as a result. But I think to your point, the bigger picture story here is really about geopolitics. We have the G7 meeting, and when I used to be taking part of the G7 meeting, this was really about economics, markets, the finance track being the dominant driver, and that has changed. This is now really about geopolitics and regional blocs aligning themselves, companies thinking about factoring these risks in how they operate now globally, and that continues to play to us. That's the main story coming out of the Japan G7 at this juncture.